Hello guys, Assalamu alaikum. I hope you all are doing fine. Welcome to the videocast series of PFS. I'm Galib, your host for today. In the last video, we discussed the first chapter of economics. Today, we will discuss the portfolio management. Our first chapter is portfolio management and overview. This is a relatively easy chapter, but we've seen candidates get confused with easy things. And to have the discussion, we have Nafis Bhai with us. Welcome, Nafis Bhai.
Welcome, Galip, and welcome our viewers.
My first question to you is regarding portfolio benefits. We all know diversification reduces risks. So many believe that downsides are limited with the portfolio. But in a section of the curriculum, it said that based on the historical numbers, it can be said portfolio not necessarily secure downside protection. So doesn't diversification mean downside protection? Can you elaborate on the section?
Thank you for your question. I think portfolio diversification is one of the very basic and trivial problems that people often find it very difficult to understand, especially in the case of that they think that by diversifying your portfolio you can protect your portfolio from losses, but that's not happen. So to understand that better, for example, if you are an investor, if you want to maximize the return of your portfolio, in order to do that, what you can do, if you are only considered about the return part, then you can invest all of your investment in the securities that has the highest maximum expected rate of return. And you can value that the asset by taking the present value of future cash flows. But the problem is you do not know which assets will provide the maximum rate of return, because the future cash flows are very uncertain. So in an uncertain world, what we do, we diversify our investments. So if we can sufficiently diversify our investment, then we can get the weighted average rate of return from our portfolio, and the risk will be reduced if our assets are uncorrelated. But the problem is all this discussion actually assume that portfolio returns exhibit normally distributed rate of return, which means mean plus minus 3 standard deviation have 99% of the total distribution of return, which means if portfolio returns are normally distributed, making a loss of more than 3 standard deviation, one occurrence out of 200 trials. But that doesn't happen in a real world, because in a real world we can see in the marketplace asset class have 3 standard deviation, 5 standard deviation, 10 standard deviation, 15 standard deviation are much more frequent than 1 out of 200 trials. So what happens when there is a market crash, or financial system, there is a trust is broken, or there are some highly uncertain events like the current pandemic, the COVID scenario, where the in most markets, assets prices are going down, and often the correlation increases. So there is a criticism for diversification, that diversification doesn't protect your losses. So it's not a downside protection, rather it's a minimization of overall risk. So in case of financial market stress, the correlation among asset classes increases. So when there is a significant increase in correlation, the diversification doesn't protect you. For example, we have seen many times in the history that there has been a severe market crash, and even if you are sufficiently diversified, you could not protect your portfolio from downside protection or downside losses. For example, we have seen in 1907 where the US banking crisis, we have seen 1929 Great Depression, 1971 when President Nixon deviated from the closed the gold window by deviated from the pegging the dollar with the gold, and in the 1970s when Organization of Arab Petroleum Exporting Countries put an embargo to punish the US for their support for Israel. We have seen 1987 when there's on a single day market had gone down by 22%. Then 1991, the Indian economic crisis. 1990s, the Asian financial crisis. 1998, the fall of LTCM. Then 2007 and 8, subprime mortgage crisis, and the current pandemic, COVID-19. All these are examples of market stress when the correlation among asset classes increases, and that's why it is being said that portfolio diversification, though it minimizes the risk, but it doesn't mean that it's a downside protection. Especially in the severe market stress during the market crash, it does not protect your portfolio. So does that mean by diversification is a fruitless exercise? Answer is no. You still need to diversify, and but you have to bear in mind that it doesn't protect your portfolio from losses.
Great. There are basically two types of pension plans, right? Defined contribution and defined benefits. Can you explain the portfolio management objectives of defined contribution and defined benefits pension plans? And is there any difference between these two?
So in order to understand the differences between the investment objectives of a defined benefit pension plan and this defined contribution pension plan, we first need to understand the differences between the two plan in terms of characteristics. For example, in case of a defined benefit pension plans, the benefit payouts are actually defined by a contract. It's defined by a formula. An employer has the responsibility to have sufficient fund so that they can pay off their liabilities. So in case of defined benefit pension plans, the primary contributor is the employer, though employee might contribute as well as per the plan contract, but employer is the primary contributor, and the pension fund determines how they will invest their assets. So in case of defined benefit pension plan, the objective is to have sufficient assets so that there is funds to meet the liabilities. In case of defined benefit pension plans, the risk is actually borne by the investment risk is actually borne by the employer. But in case of defined contribution pension plan, the plan benefits are not defined by contract. It's not, the benefit is not defined. Rather, the benefit depends on the performance of investment portfolios. For example, the employees have the option to choose from many different investment vehicles, and some are very aggressive and some are very risk averse, so they can choose the investment vehicles based on their risk return preferences. So in case of defined contribution pension plan, employee is the primary contributor, though employer can contribute as well, and investment risk is borne by individual employees. So since the defined contribution, the investment risk is borne by individual employees, so what they can do, they can invest their securities in a way that meet their investment objectives and risk objectives. But since different individual employees differ in terms of their circumstances, in terms of their need for fund, in terms of their age, so there is a huge differences between the huge variation among the different employees. So their investment characteristics will be more like how individual investors invest. So the investment objectives based on each individual circumstances and their investment goals and their risk tolerances.
Oh, excellent. There are different types of institutional funds. I saw many people get confused between endowment, foundation, or defined benefits. So, can you clear that confusion and tell us how investment objectives differs among these three, and what are their investment objectives actually are?
Thank you. Endowment and foundation are quite different from the defined benefit pension plan. For example, in case of defined benefit pension plan, they have to invest in a way, for example, asset liability perspective. For example, in case of asset liability perspective, you always have to keep track of your liabilities, and your assets return should have high correlation with the liabilities rate of return, so that the risk of underperforming the liabilities, or risk of falling short of your liabilities is much lower. In case of foundation and endowment, compared to defined benefit pension plan, the time horizon is extremely long. In most cases, endowment and foundation will try to invest up to perpetuity. So endowments are actually created by universities, museums, hospitals, church, etc. And normally these are created from donations and gifts, and the primary objective is to manage the fund in a way so that its real value is protected, and there is sufficient investment, sufficient return need for each year, so that they can meet the operating expenses from the fund's rate of return every year. Foundations are quite similar, and also it wants to achieve rate of return that protects its investment value, and each year there are sufficient return needed for meeting the spending needs. For example, in case of United States, the private foundation needs to spend 5% of their total portfolio in order to get a tax benefit. So there is sufficient spending needs, and private foundations are often created to provide benefits to its beneficiaries, or sometimes it is created for philanthropic purposes as well. But the main idea, the investment objective, is to protect the value of the fund till perpetuity, and achieve sufficient rate of return, so the spending needs and goals are matched.
Excellent. My last discussion topic for today is ETF, exchange traded fund. I must say it's a very timely topic, but most of the people find it extremely difficult to understand the creation redemption process of ETF. So, can you please explain the creation and redemption process of ETF?
The concept of exchange traded fund is quite simple. It is very much like the traditional mutual funds, but differs in a way that ETF shares are actually traded on a continuous basis in a marketplace, compared to the traditional mutual funds, where the open-end mutual funds are not traded, and the NAV is calculated in most countries on day end. In case of Bangladesh, the NAV is calculated on a weekly basis, but exchange traded fund trades on a daily basis, so you can buy exchange traded funds anytime during the market, when the market is open. So the question is how the exchange traded fund creation and redemption is done. So to show that, let me show you an example. In case of ETF, the only investor who can be involved in the creation and redemption process is called the authorized participant. So typically the authorized participants are large brokers or dealers, and who are typically the market makers as well. So authorized participant can trade directly with ETF manager. So ETF manager, every time, every day, ETF manager publishes the list of securities, the list of securities that is in their portfolio. So every time they show a basket of portfolio that is in a basket of securities that is in their portfolio. So but there is an investor who wants to buy ETF share. The investor comes to AP, and AP let the information know to the ETF manager that they have to create some ETF shares. So what the AP can do, they can buy securities from the marketplace. So they go to the market, and from the market they buy similar number of securities from the portfolio. So they deliver their securities to the ETF manager, and ETF manager delivers AP the new shares of ETF. So in case of ETF, this creation process is called in kind, because there is no cash transaction between the AP and the ETF fund manager. So what the AP could do, so AP buy each stocks or bonds from the marketplace and create a basket of securities. They deliver that basket of securities to the ETF, and ETF manager delivers the newly created ETF shares. So when there is a redemption, so redemption acts like just the opposite. What the AP does, AP does the transaction with the ETF manager. So AP delivers the ETF shares. So ETF shares are being delivered from a authorized representative to the ETF manager, and what ETF manager delivered to the AP is the basket of securities. So does that securities basket consist of many different individual stocks and bonds, and what AP can do, AP can sell those shares on a piecemeal basis in the market. Again, this is the redemption process is again in kind because AP is delivering ETF shares to the ETF and ETF manager, and ETF manager delivers the basket of securities to the AP. Next question is why authorized participants will want to do it. Authorized participants only will chip in when there is a difference between the net asset value of the ETF fund and the market price of the ETF. So in the market, the ETF prices are very low. What the authorized participants can do, they can buy those ETF from the market, then deliver the ETF shares to the ETF manager and gets the basket of securities whose value is much higher than what AP bought from the marketplace. Then if AP sell those securities in piecemeal in the market and earn a rate of return. And this is the same thing, the opposite thing happen when the ETF prices are higher than the individual securities. Then AP buy securities from the marketplace and deliver those securities to the ETF manager and get ETF shares, and those shares can be sold in the market at a higher price. Difference between ETF NAV and the ETF prices. So if the ETF prices are much higher or lower compared to the ETF NAV, then AP has a sufficient opportunity to make arbitrage profit by doing this transaction. Uh, Other than that, what AP can do, since there is a natural demand for the ETF shares, so whenever ETF shares are being redeemed or created, AP is doing those transactions in the marketplace. So by doing that, AP is earning also commissions from every transaction.
Nice. That's all for today. Thank you everyone for being with us. I hope the session was very informative for all of you. Take care and be safe be safe.
Thank you, Galib, and thank you, our viewers, for watching this.